Professor.
Hi, Barbara.
Can you guys hear me?
They don't know who you are.
Oh, this is Tori.
Okay, good evening, everybody. Let's wait a couple more minutes for everybody to show up. So hang on just for a minute, please.
Quick question. So my audio is the call-in user number _2. I can change the name of it in my window to Tori's audio, but does that reflect on anybody else's window?
Don't know the answer to that one, Tori.
Okay. I was just curious. Sorry.
That's okay. Why don't you go ahead and change it? Let's see what happens.
So I did. Is it listed as?
No, now you have two calls, user 2 and user 3.
So I'm user 2. So changing it on my end doesn't change it for anybody else.
No.
That's a bummer.
Hi, this is Kathy. I just joined.
Hi, Kathy. Are you user 3?
I think so. I'm still getting in online.
Okay. Now, Tori, I see you. Your name?
So that's my computer, so I can see the
computer.
screen.
Okay.
Yeah, but so I had to call in because I still haven't figured out the audio problems on my computer. So.
Okay. Who is owner?
That would be me. That's Kathy.
Thank you, Kathy.
I just said I don't think I knew how to figure out how to name it on the computer for the WebEx. So.
And in WebEx, you just go into your profile. There's in the upper top right corner, there's a little picture of a head. If you click on that, you can change your profile and name it. Name your profile.
Okay, I'll see if I can't find that.
No, don't worry about that. What? If you do that, it might whack things out. I'm happy just to know that you're Miss Owner. That's fine by me.
Okay, that's me.
Okay.
And in between classes, I'll try and figure it out.
Okay. I'm going to wait a couple more minutes. This is the make or break week for a lot of people. This is the week you can drop the course if you so desire. And not really get hurt by, you'll get hurt by, you still have to pay for a portion of it, a large portion of it, but you can get hurt, you cannot get hurt by getting a WF, a withdrawal fail on your grades. You can just drop the course and will not hurt your grade point average. So this is a big week for a lot of people to make the decision whether they want to continue with the course. So we might want to see how many people show up this evening. Barbara, answer me this, Barbara.
Good.
Did you get an email this weekend from the university asking you to do a midterm evaluation of the course?
I don't think so, Professor. Let me review my email once again, but I don't think I did. Let me check it out.
I might.
This is Tori, and I got one.
You got one. Okay, I was going to mention that this evening, so we'll talk about that. That's good. I'm glad you got it.
First time I've seen it, so I haven't done it yet, but
this is a new thing for this special term, so we'll talk about that.
To receive it.
You got it, Barbara? Okay,
Yes.
thank you. Thank you.
And this is Kathy. I got it too.
Okay, good. Thank you, Kathy. We'll start in 1 minute. Okay, good evening, everybody. Let's begin. I am recording this class again this evening, so you can play this back. A little bit difference on how you can view the class recording for our class. The WebEx server that you are learning on is getting too impacted with too many recorded videos, and they are not being able to hold on to those videos as a replay of a class. It's taking up too much space. No problem for Professor Hasse. He has a solution to everything. And what that is if you want to replay a class, you can go to our YouTube playlist in Blackboard. And I'll show you that a little bit later. But you can go to the YouTube playlist and watch every class that has been recorded. The link to that YouTube playlist is in the WebEx YouTube link file folder in Blackboard. So even though WebEx can no longer keep the recorded versions on in their space, in their cloud, I guess you could say, I download the class and put it into our YouTube playlist so you can watch it there and record or watch the class over again. So just note that for future, if you want to replay a class, you can go to our YouTube playlist and watch the recorded class. All right, well, I hope everybody is well and happy. We begin our week 4 of online learning, week 5 of being cooped up in this crazy quarantine situation here in California. And after talking to many of you over the last week on our student interviews or student sessions with myself, you all are doing very well and getting used to this format of learning accounting here at the University of Louvain, and I thank you all for your diligence in keeping up with this. I appreciate it. Here's our agenda for this evening. We still have students posting quiz number 2, so I'm not going to go over the detail of quiz number 2. Once I have all the quiz number 2 postings in this week and I post the grades, I'm going to do a special video off class, but a special video explaining quiz number 2 and how I graded quiz number 2. So once all the quizzes are posted this week, I will send you an email and you can go to YouTube playlists and you can watch a video explaining quiz number 2. All right. But I am going to go over the accounting cycle a little bit. We're going to talk about specifically tonight, Chapter 5, merchandise or retail accounting. And then we're going to begin and just talk about the definition of Chapter 6, inventories. Now, I know you don't have the syllabus in front of you, but I'm going to bring up our syllabus, our original syllabus for this course. So I'm going to bring this up right now, so bear with me. Barbara, can you see our syllabus in front of you? Thank you. Okay, Barbara's my assistant tonight. I can see her on the screen readily. And if I need to make sure everything is being done, I can go to her. Notice our original syllabus called for tonight talking about chapters 8 and 9. And next week, our midterm examination, chapters 1 through 9. Also this week, you were to submit your project company to Blackboard in the discussion forum. But I've changed all these, and we talked about this a little bit last week, but I'm refreshing your memory. We're only going to go through chapter 6 for our midterm examination, which you'll be given next week. So we have 2 more class sessions tonight and next week to talk about chapters 1 through 6. We're going to have a review session next week on chapters 1 through 6. And then next week, I will give you your midterm examination, and it'll be due Sunday, April 26th. Your student WebEx companies are due on Sunday, April 19th. Now, one of you have already given me your company, and it looks great. But if you go to the discussion forum, I have a forum set up where you can tell me the company that you're selecting for your paper. We talked about that last week. And at the same time, you can also explain to me why you picked that company. And that's due this coming Sunday, April 19th. All right, make sure you do that by Sunday. This is a graded work. This is part of your paper grade, is giving me this information by Sunday, April 19th. So submit that. We've done the first 2 quizzes on chapters 1 through 4, both quizzes, chapters 1 through 4. And tonight we're going to talk about chapter 5. We are going to talk about chapters 8 and 9 on April 27th, the week after our midterm. So don't worry about chapters 8 and 9. And we're just going to slide everything down a little bit for the balance of our term. So our midterm examination is just going to be on chapters 1 through 6. I think that's fair to you. I think that's give us time to learn it and understand it and practice it. So we're going to do that. When I post the video this week to explain the quiz 2 review, I'm also going to give you some sample questions, sample problems as a study guide for the midterm examination. All right? You do not have to do these. They're not for a grade. They're just giving you the opportunity to practice some additional problems for the midterm. We will go over those problems next week in class with the solutions posted to Blackboard. So you will have some additional problems if you want to do them, some additional practice to do the problems from chapters 1 through 6. So that's where we stand in class. Tonight we're going to talk about chapter 5 and begin our discussions of chapter 6. Next week we're going to talk about chapters 6 and then do our review session for chapters 1 through 6 in class next week. At the end of class next week, you will get your midterm examination and off we go to the races. So I think that's going to fit into some of our learning aspects of this class, help you study a little bit more, become a little bit more comfortable with the accounting language. And also it fills out my commitment to you to make sure you're getting your full value out of this class. Any questions on my change in the syllabus schedule?
No, sir. I just want to say thank you. That's a huge sigh of relief for me personally. This is Tori. So thank you very much.
Well, I after talking with you all in our sessions, after looking at the material, I think this is a wise move and to make you learn. That's the best thing. It'll make you learn it. So that's the good thing about it. Okay. Speaking
Hi,
of,
it's Kathy. I'd like to say, I would just want to say thank you too. I do appreciate it.
you guys don't have to thank me. I appreciate that, but you don't have to.
Okay.
Thank you. But that's nice that you do that. Okay. So now I'm going to get rid of this item here. And I'm going to bring up another item here. Okay. As Tori and Kathy mentioned earlier, the university sent out a survey to you all this weekend, and the survey is due to be completed by April 17th. And this is something new to University of Laverne. It's because of the circumstances by which we're teaching this term. The usual rule of thumb is, and many of you who've taken a class before have done this, is at the end of the term, the last week of the term, you are asked to fill out a survey, a course evaluation of the course, and tell us about your feedback about the professor, about the subject, about everything having to do with the course. But we're going to be doing it twice this term, especially because so many of you are now, for the first time, dealing with the online platform. And you and the university and myself want some feedback from you on how it's going. And we kind of answered some of these questions in our one-on-one discussions, but how you feel about this and how I'm doing my job, how the university is doing their job to make sure that it's somewhat of an easy transition to the online. I know for a lot of you it's not, and I understand that, but let's just chalk it up as a learning experience. So if you could please fill out this form this week, asking you some questions about the course material, the assignments, whether I'm paying attention to you, whether I'm a moron or okay. It's both pro and con feedback. You don't have to, if you don't feel that you don't want to do this form, you don't have to. It's not a requirement. You're not graded on it. I don't know who filled out the form. It's all anonymous. It's just telling the university and me basically what your feedback is after only 4 weeks of the course. That's kind of a short time, but it's about getting close to the halfway point. And we want to make sure that you're being satisfied with the environment that you're learning in. So if you all could take a couple moments during the course of the week, it's due on Friday, April 17th, and fill out that form that was sent to you with the link. And I would appreciate that. And that would be of a big help to me if you sort that and fill that out. I would appreciate it. And if you have any questions on that, just let me know. But again, this is something that makes us a better institution, makes me a better teacher, and helps everybody get their full value out of the course. So that's that mid-course feedback evaluation that you received this weekend, due April 17th. So thank you if you could do that. I'd appreciate it. Now, as I see Marianne has come on board. So Marianne, I am recording this class. So since you missed about the first 20 minutes, but no worries, I'm recording it. You can go back and look at it once I post the recording to YouTube after the class, probably sometime tomorrow. So just you can check within there. But this is our agenda for tonight, Marianne, and welcome. I hope you're fine. This is our agenda for tonight. I am still awaiting some quiz number 2 postings, so I'm not going to review that specifically this evening, but I will send out a special video this week once I have all the quiz 2 results and filings. I will show you how I graded it and what the feedback and the solutions for that quiz number 2, because quiz number 2 is important. It will help you study for the midterm next week. All right, now let me bring up something else. All right, Barbara, you see that accounting cycle slide? Okay, thank you. This is what quizzes 1 and 2 were all about, the accounting cycle. And this is to make sure you're familiar with it, know what it means, know the terminologies. And now, after doing quiz number 2, you should be familiar with these steps of the accounting cycle. And that you are going to have a couple of questions on the midterm involving this. And as I said earlier, I'm going to be giving you, later later on this week some practice problems to try and do. And if you want to do them, you can. If you don't want to do them, that's fine. They're not for a grade. They're just to practice. And we're going to review these problems next week in class. Okay. And I'll provide the solutions. They're a good study guide for the midterm. But what we have done up to this point in class is in chapter 1, we defined accounting. The definition of accounting is a science or a discipline that totally confuses you. That's a good definition of accounting. All right. Hopefully not now, but maybe. Accounting is the recording of business events and transactions to show how a company is doing. Chapter 2, we began to put together those business transactions with journal entries. Those journal entries are posted to the general ledger. And from that general ledger, you get the account balances, which are listed, debit balance or credit balance, depending on the account, and the trial balance. Trial balance is not a financial statement. It's just telling us that our books, our ledger, is in balance. From that, we go into chapter 3, which is a study of adjusting journal entries, the adjustments of revenue, expense, assets with liabilities, with the passage of time where certain things happen, adjusting journal entries. Again, we post those to a ledger. We do an adjusted trial balance. And then we prepare the financial statements over those adjusted trial balance. The 3 financial statements that you need to be familiar with are the income statement, which is a statement of revenue and expense for a specific period of time. The statement of owner's equity, which is a statement of the equity position of the company for a period of time. And the balance sheet, which is a statement of assets, liabilities, and equity on a particular date in time, usually December 31st. Those are the 3 financial statements that can be prepared from the adjusted trial balance. Once the financial statements are done, then you close the books and prepare your financial records for the next accounting period. You close out the temporary accounts, revenue, expense, and owner withdrawals. Those accounts are closed through the journal entry called the closing entries. You post those entries to the general ledger, and your final statement to move into the next accounting period is a post-closing trial balance showing all the debit and credit accounts that remain after you have closed the books. So the only accounts that are made up in the post-closing trial balance are balance sheet accounts, assets, liabilities, and the owner's capital account. Withdrawals, revenue, and expenses are all 0 and not part of the post-closing trial balance. That's the accounting cycle. That's what we did through quiz number 2. And as I grade those this week, I will see how we are doing. And also you're going to be given more practice problems to prepare for the midterm involving this accounting cycle. All right. Now we move on to the next phase of our course. All right. The next phase of our course. Doesn't mean we're going to stop thinking about the accounting cycle. We won't. But now we're going to talk about retail accounting. Retail. What's retail? Well, you guys know that one. Walmart is retail. Costco is retail. Hardware stores are retail. Something that we haven't done in a while, hair salons are retail. All right? Even restaurants are retail. What's retail? You go to some place that provides a product, a meal, items that you want to buy, and they sell it to you through their market, through their distribution. Nowadays, a lot of us order it online. Amazon is retail. Right? They're intermediaries. They provide food. They provide products for you to use. Right? They purchase the products from a supplier. Then they put them in their stores or in their online warehouses. And then they sell them to you at a price higher than what they paid for them so they can make a profit and cover their costs. It's called sales. So that's what we're studying in chapter 5. definition of what retail accounting is. Some of you might even work in retail and probably know about this already. Probably don't know about the accounting of it, but you know how retail works. All right, let's take a look at a couple slides that define retail. Barbara, can you see this sign, reporting income for a service organization? Thank you. Thank you, dear. All right. Up to this point, chapters 1 through 4 were on service organizations or companies that provide a service, consulting, advisement, taxes, accounting, law firms. They provide a service, and that's what we've been doing up to this point in class. Service organizations sell their time and efforts of providing you a service to earn revenue. Their expenses are what it costs them to provide that service, and then they make a profit. That's what we've been doing up to this point. That's chapters 1 through 4. Now, what we're doing is now we're going to be a merchandising company, a retail company. Right? These slides are taken right out of your textbook. Merchandising companies, as I said earlier, sell products to earn revenue. Right? Merchandise companies sell products to earn revenue. And notice the flow of their financials, a little bit different than service companies. Sales minus cost of goods sold equals gross profit. Minus expenses equals net income. So now the difference between this and service companies is now we add a different layer of expenses. It's called the cost of goods sold. What it costs you to buy the goods and services that you sell to your customers. Then you have the other operating expenses of the company. They're called, in some respects, period costs. HR, accounting, management costs, advertising. But the cost of buying the merchandise that you sell is called cost of goods sold. So you sell a product more than what it cost you because you got to cover these expenses in order to make a profit. So net sales minus cost of goods sold equals gross profit minus expenses equals net income. That's what we're studying in chapter 5. We have to find, now we're learning about how to record a sale, how to determine what it cost us to buy the merchandise, and put that into our accounting format, our accounting cycle format. That's what the definition of merchandising is. Now, in order to keep track of cost of goods sold, we have to have what is called inventory. Inventory. Inventory is buying the product. Let me explain inventory. A lot of you live out here in Laverne, San Dimas, Claremont, live out in this area, Glendora. You ever drive down the 10 freeway towards the Ontario airport? And all surrounding Ontario airport are these huge, big buildings along the freeway. Huge, big distribution centers. Many of those distribution centers are owned by Costco, Walmart, Amazon, Target. And what are those buildings for? That's where they store the products that they end up selling to us. It's called inventory. Those warehouses or those distribution centers off the 10 freeway are centers to hold on to the merchandise until we sell it or ship it to our stores to sell it to our customers. It's called inventory. So here's an important concept in this chapter. When you purchase a product that you're going to sell, it's called inventory. When you sell that product, it becomes a cost of goods sold. I'll say that again. When you purchase a product that you're going to sell to your customers, it's inventory. Inventory is an asset account. When you sell that product to your customer, you no longer own it. it now becomes an expense cost of goods sold. All right. That's the main difference in Chapter 5 from anything else. The recording of a purchase of a product and the recording of the product being sold. Right? That's an important concept in Chapter 5, one that we have to understand in order to do the accounting for retail. We have a problem set 5-1A, that we're going to look at as a sample of these transactions, and we'll look at those a little bit later. I want to make sure we understand the definition. Let me see. Let me hold up a product here that I have at my desk. Let me see here. What do I got here? Hang on. I got something here. Yes. Here we go. Let me hold this up so I don't screw it up. This is our textbook. There it is. See it? This is our textbook. All right. If you were to buy this textbook, all right, at the very back on the last page or the last back cover of the textbook, if you have your textbook handy, look at the back cover page of the textbook. You'll see what is called in the lower right-hand corner a barcode. All right, that's a barcode. That barcode is when you purchase the textbook from, let's say, a bookstore or Amazon, they run that barcode through their accounting. And when you hear that beep, beep, like the sound effects, beep, that's the barcode recognizing the barcode information on that product. And when that barcode does that beep, 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 it changes the accounting information from recording the asset inventory to now recording the expense cost of goods sold. Because that beep indicates that the customer has purchased the product and is going to pay you revenue, sales. And now that barcode tells the accounting system to debit cost of goods sold and credit inventory. So here's something you can do to get you kicked out of any store in America. If you're in the checkout line and you're doing your groceries or your products that you purchased, and you hear that beep going off, beep, 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 all the time, you can tell the cash register lady, hey, I know what that's all about. It's debit cost of goods sold and credit inventory. I guarantee you, as soon as you say that to the checkout lady, she will go, get the hell out of here. What are you talking about? I don't know what you're talking about. But that's exactly what happens when you hear that beep. It's making a journal entry to the accounting system of that retail company. And we'll practice that journal entry without the beep, that obnoxious beep, later on in our class. So the next step that we want to talk about is here's the operating cycle of a merchandiser, a retailer. Right? You purchase the product either for cash or an accounts payable. Once you buy the product, you put it in your warehouse, in your distribution center, on the shelves of your store, and then you sell the product. You can sell the product for either cash or you can have credit sales, credit card sales, invoicing, and that goes into accounts receivable. And then you collect the cash. So you purchase the merchandise, put it in inventory, and then sell it, and you start the whole process over again. That's the cycle of this. And here's how inventory systems work. You have a beginning inventory, what's left over from the prior period. You add in additional purchases of that product during the year. You now have merchandise available for sale. Then from that, it splits off. Inventory that you sold to your customers becomes an expense, cost of goods sold, and inventory that you have left over at the end of the period is still an asset called ending inventory. This number, ending inventory, is on the balance sheet. This number, cost of goods sold, is on the income statement. And it's closed out in the closing process at the end of the period because it's an expense or temporary account. That's the flow. Asset becomes selling, expense, or if you don't sell it, It's in ending inventory. That's the flow of merchandise. Then the textbook talks about inventory systems. Ugh, this is creepy. The systems of inventory. Perpetual systems is the one we will be using in our class. Periodic, strike out. Don't worry about it. We are not recording periodic systems. In other words, a periodic system is updating your records at the end of a cycle. All right? Don't worry about that. We're going to be using the perpetual system of inventory. In other words, we record every purchase and every sale. We don't wait to the end of the period to record inventory. I'll say that again. We don't wait till the end of the period. We are constantly doing inventory transactions, and it's called the perpetual inventory system. That's what we're going to be doing in this class, perpetual. Write that down. We're not doing periodic. Now, here's the typical journal entry of purchasing merchandise for cash. Notice it's going on November 2nd, Z-Mart purchased $500 of merchandise inventory and they paid in cash. Notice debit merchandise inventory, credit cash. What's merchandise inventory? That's an asset account. We now own that product, and that product is going to go on our shelves or in our distribution houses waiting to be sold to our customers. That's the purchase of merchandise. Now, sometimes, and a lot of times, maybe some of you know about this, companies give you a break. It's called a discount when you purchase merchandise. All right? Sometimes you can get a discount by purchasing merchandise. And here's a perfect example. The same example of November 2nd, Z-Mart purchased $500 of merchandise on account, not with cash, but they're going to get an invoice. And the invoice terms are 2/10 N/30. What the hell does that mean, Mr. Hassey? 2/10 means if you pay that invoice within 10 days of the date of the invoice, you get a 2% discount. 2% off of the $500. If you don't pay it within 10 days, you have 30 days to pay the full $500. But the discount gives the company incentive to collect their money quicker. At the same time, you as the purchaser of that merchandise get a little break. 2% of $500. What's 2% of $500? Sounds like 10 bucks. All right, you get a little bit of break. So many times you can purchase things with a discount. Vice versa, we'll see this in a minute. As a customer, you can get a discount if you purchase things on a discount. We'll talk about that in a minute. So again, 2/10, net over 30. 2% discount if you pay within 10 days of the invoice, net over 30. In other words, the entire invoice is due in 30 days. That's what purchase discounts mean. Now, if you're paying in cash, no discount. You're paying upfront cash. Some companies do give discounts for cash, but usually nada. All right. Now, if any of you have ever seen an invoice, maybe some of you have, you can see the various information on that invoice. And here, right here, is the terms of an invoice. All right. 2/10, net over 30, how much you're purchasing, and the invoice of a product. Now, here's an example. If we happen to pay, remember I talked about the $10, 2% discount. If we happen to pay within the discount period. Remember, the original entry was to debit merchandise inventory, $500, and credit accounts payable, $500. But notice we are paying within, we purchased this on November 2nd, and then on November 12th, we're going to make a payment to this company. It's within the 10-day discount period. So we take 10% or 2% off of 500, that's $10, excuse me, and we debit accounts payable $500. We wipe out that credit or that liability. we write a check for cash for $490, and we credit the inventory account by $10, lowering the amount of the inventory we purchased to $490. We take that discount to lower the value of the inventory because we're paying it back within a discount period. All right, that's the journal entry to record that in Chapter 5. Here's how it looks on the ledger accounts. We incur the liability, we pay the liability, we incur the inventory asset, we reduce that asset by the discount amount and pay the amount less the discount, $490, and our merchandise inventory balance now matches what we paid out in cash, $490. Now here's an example of if we pay after the discount period. We just wait 30 days to pay the invoice. So notice no discount. Accounts payable is debited $500 and cash is credited $500. That's a normal payment of paying off the liability with cash, wiping out the purchase that we made of the product. Now, another change that we will see is what happens if you purchase a product from a vendor and you don't like it. Many of you do this a lot in your return merchandise that you don't like. Or they give you an allowance, a reduction for defective merchandise. Maybe you get a box from Amazon and it has a bunch of stuff in it and two items are broken. Well, you send those two broken items back and they'll give you credit on your account because you don't have to pay them. That's purchase allowance, purchase return, purchase allowance. Here's an example of the journal entries for this. On November 5th, Z-Mart issues a $30 debit memorandum for an allowance from Trex for defective merchandise. In other words, the buyer says, wait a minute, $30 of this product we bought from you stinks, so we're returning it. We want an allowance, or we're going to throw it away and you give us a reduction of our bill. Well, this is what happens. They debit accounts payable $30 and they credit the inventory account saying that, okay, we no longer have that $30 of product. We're reducing it and we're lowering our bill because we said $30 of it was lousy. Right? That's a purchase allowance. A purchase return is when you, for example, Z-Mart purchased $250 of merchandise on June 1, terms 2/10, net 60. On June 3rd, Z-Mart returns $50 of goods before paying the invoice. When Z-Mart pays the invoice on June 11th, within the 10-day discount period, it takes 2% discount on only the $200 balance because they returned $50. The difference between purchase allowances and purchase returns, purchase allowances is you don't return it, but you still take a credit on your invoice. You don't pay a certain amount of it. You keep that spoiled goods and throw it away in the garbage or whatever. Purchase return is you return the merchandise in the box or back to the vendor to get the credit. So here's the transaction on June 1st. We buy $250, put it in inventory. We credit accounts payable. Then we return $50 back to the vendor, debiting accounts payable, lowering the amount we owe, and crediting inventory because we're shipping that back. Then we pay the invoice on June 11th within the discount period. Accounts payable is debit. 2% of $200 is $4. We get a credit on the inventory and we write a check for cash for the difference, $196. This can get a little involved, but it is a normal procedure in retail is to purchase and return certain amounts of product. And as a customer, you do the same thing. Right? So that's an important part of this. Now, let's take a look at the selling side. All right, the revenue side of retail. We just looked at the purchase of merchandise that we're going to sell. Let's take a look at the accounting for the sales. Okay, Sales in retail are a combination of your revenue, what you collect for the product, plus or minus any discounts, returns, or allowances you give your customers because of that sale, minus the cost of goods sold, what it cost you to sell that product. That gives you the gross profit. Here it is right here. Each sale of a transaction involves two parts: the revenue you received and the recognition of the cost of the merchandise sold to the customer. That's called the cost of goods sold. Revenue, cost of goods sold. When you recognize the sale, you have to do two entries. Here's some examples. Z-Mart sold $1,000 of merchandise on credit. The merchandise has a cost basis of $300. In other words, you sold it, it cost you $300 to buy the merchandise, you're selling it for $1,000. Geez, pretty good. They sold this on credit. So notice the entry. A sale has two entries, the revenue side and the expense or cost side. The revenue side, they're selling this on an account, that's credit, debit, accounts receivable. They owe you the money. And the sales are credited, that's a revenue account called sales, credit, $1,000. The cost side is it, remember we told us in the problem, it cost us $300 to get that merchandise. Debit, cost of goods sold, that's the expense. And credit, the asset account inventory, $300, lowering the amount of inventory because you now have sold $300 worth of that inventory. That's how that works. One transaction, two entries to record the revenue and to record the cost or the expense. Very important concept. When we hear the beep, beep, beep of the barcode, those are the transactions that the beep produces. The recording of the sale, could be cash, it could be receivable, and the recording of the expense, what it cost you for the merchandise, and lowering the inventory. That's why every night, if any of you have ever worked at Costco, Target, or major retail organizations, as soon as the door closes, they run a report of the day's sales. And in that report, it shows all the merchandise that was sold during the day. Now they know how much they have to restock their shelves overnight. So a whole nother group of employees come in overnight and take, oh, geez, we sold that many basketballs today. We got to put some more back into the shelves. Oh, we sold that many cars today. We got to put more cars back in our inventory. So that's when they restock stores. I went to the supermarket the other day very early. I think it was at 6 a.m. And I walked in the supermarket at Vons, and they had all these people in the aisles with empty boxes restocking the shelves. Toilet paper was not one of them, damn it. But be that as it may, they were restocking the shelves. How did they know what to restock? Last night, they ran the accounting report that told them what inventory items were sold and what they have to restock. Now, naturally, they could look at the shelves and say, geez, we're out of toilet paper. I guess we better get some. But more technically, you can get that specific amount of inventory that was sold by running the reports at night and then doing your restocking once the store is closed and you can restock. That's how that works. Now, they're also, just like in the purchases of merchandise we saw earlier, there are discounts for sales of goods. There are discounts. You give your customers a discount. All right. Here's an example. Z-Mart completes a $1,000 credit sale. We send, the person gets the merchandise. We send them an invoice. The invoice says 2/10, net 45. So on November 12th, we sell the merchandise on account, debit receivable, credit sales. And then on November 12th, we record the cost of good, the expense of the inventory that was purchased. Now the buyer in the next example pays within the discount period. 2% of $1,000 is $20. So if they pay us by November 22nd, that's 10 days, they're going to give us cash of $980. The sales discounts will be debited for $20 and accounts receivable is credited, wiping out the original transaction of accounts receivable, $1,000. Where does that $20 go in your accounting records? That is a revenue account. It's a revenue account with a debit balance. So we sold $1,000 of merchandise less the sales discount, 20. We actually sold net sales $980. That's how that works. Sales discounts is a revenue account with a debit balance. The last example of this, they pay within 45 days. Whatever. Yeah, 45 days of the discount period. So they don't get a discount. They pay you $1,000 and wiping out the receivable, $1,000. That's a sales discount. It's another revenue account, but with a debit balance. Stop right here. People do this for a living every day. All right. The next section of this is sales returns and allowances. Just like purchase returns and allowances, customers can return merchandise. You ever go into a Costco? Some of the longest lines are in the front of the store with people returning merchandise. In return to that merchandise, they get a credit on their credit card bill. They get a cash back of what they're returning. That happens a lot. So here's some examples of sales and returns. The customer returns merchandise which sold for $15 and had a cost of $9. Well, there's the original entries. Sales returns. So sales returns. Now they're returning the merchandise for $15 and it costs $9. So notice the account that's debited. Sales returns and allowances, another revenue account with a debit balance. And they're returning it, so you have to give them their money back. Cash is credited, $15. Notice at the same time, we have to do another record to put that inventory back into stock. If they're returning us that merchandise, we might put it back on the shelves again, put it back into inventory, debit inventory $9, and we credit the expense accounts, reducing the amount that was originally purchased and the cost by $9 because $9 of that product was returned. That's inventory that's not defective. You just put it back on the shelves. But then if you have inventory that is defective, that cannot be resold again, all right, here's the transaction. Let's say they determined that $7 of that is defective merchandise. $2 of the cost is returned merchandise. Debit returned a merchandise, $2. And this is an expense account called loss from defective merchandise. You're expensing. For some of us might be, in many companies, this is called scrap, or returned merchandise that you're never going to be able to sell. And notice that amount that's defective, that can never be sold again, is in a separate account from inventory. And then we credit cost of goods sold, $9, wiping out that expense. These slides are very important, and we're going to practice problems like this, but these are the key areas of the differences in retail accounting. All right. And here's how it's all summed up. All right. This gives you a headache just looking at this. All right. But we've looked at this before. We have beginning inventory. We buy additional inventory from a supplier. Inventory, merchandise available for sale. We sell some of it, it becomes an expense. We keep some of it on our shelves, it's an ending inventory. The cost of goods sold goes on the income statement or the income statement. The ending inventory is a balance sheet item. We go into the next period. The ending inventory becomes the beginning inventory. And we do the process again, period to period. Cost of goods sold account is an expense account, and that is closed every period. But the ending inventory, the beginning inventory, the ending inventory stay on the balance sheet and they go forward into the next accounting period. That's how this works. All right, let's take a break. It's the 7 o'clock hour. Let's take a break. When we come back from break, we're going to look at problem 5-1, 5-1A on page 204 of your textbook. Problem 5-1A on page 204, which is all samples of these transactions we just talked about in this beginning lecture. So let's take about a 10-minute break. I'll see you back here at 10 minutes after the hour, and we'll look at problem 5-1A on page 204. Okay, see you back here in about 10, 11 minutes. Thank you, everybody.
Keep his mind on nothing. He turned the world for a good thing he found. She is bad, he can see it. She can do no wrong. Turn it back on his best friend. He put her down. When I made it on, spending every last time. Trying to hold on. He give up all his promise. Sleep out in the rain. She said that's the way. So she can bring it. She's bad. You know that I love you. Made up myself. I love you and no more. Giving up a lot. Time and you go. Pretty woman, walking down the street. Pretty woman, the kind I like to meet. Pretty woman, I don't believe you. You're not the truth. No one could look as good as you. Mercy. Pretty woman, won't you pardon me? Pretty woman, I couldn't help but see. Pretty woman, and you look lovely as can be. Are you lonely just like me? Wow. Pretty woman, travel wild. Pretty woman, travel wild. Pretty woman, give your smile to me. Pretty woman, yeah, yeah. Pretty woman, look my way. Pretty woman, say you'll stay with me. 'Cause I need you, I'll treat you right. Come with me, baby. Pretty much tonight. Pretty woman, don't walk on by. Pretty woman, don't make me cry. Pretty woman, don't walk away. Hey, okay, if that's the way it must be. Okay, I guess I'll go on home this lady. Tell me tomorrow night. But wait, what do I see? Is she walking back to me? Yeah, she's walking back to me. All at this time, by presenting to the spotlight for your approval, three dynamic young ladies of song, directly from the Ed Sullivan Show, the Fantastic Supreme.
Okay, we are back. Music supplied by Pandora at no expense to you. The station is Carolina Beach Music. If any of you are familiar with Pandora, it's the radio station Carolina Beach Music. For my generation, it's good. Not that rap crap that we listen to these days. That's Mr. Professor Halsey's musical review. Vince, talk to me. Are you there, buddy? There he is. Okay.
I'm here, sir.
Vince agrees with my rap crap. Thank you, Vince. You just earned some extra credit for the evening. All right.
I think that there is art in everything. How about that?
Very good. I probably offended by somebody by that statement, but I stand by that statement. But I totally agree with you. Art is in the beholder. Beholder looks at art differently for everybody. I agree with you. Thank you. That's a very politically correct statement. It's still rap crap. Ha ha. But now I'm going to get in trouble. Here we are doing your evaluations of the course so far. Professor Hassey's okay, but I don't like his commentary on music. All right, that's all right. I can deal with that. That's all right. All right, Barbara, do you see problem set A on your screen? Barbara, you are one good assistant tonight. Thank you. All right, we are now going to look at an example from our textbook and do these transactions a lot like we did in our opening hour lecture. Again, these are recording merchandising activities using, as we described earlier, the perpetual system of inventory. So we're going to do these journal entries. You will have a problem on next week's exam that's very similar to this problem. So this is one to record. Now I'm going to be doing the transactions and posting these to our week 5 Blackboard so you can see these later on as a template on how to do these transactions. I am on page 204 of your textbook, problem set 5-1A. So here we go. If you want to do these and follow along with me, that might be cool. If not, I am doing a Excel sheet and we're going to fill in these answers on this Excel sheet and I will be posting this to Blackboard. Okay. Prepare journal entries to record the following merchandising transactions of Cabela's, which uses the perpetual inventory system and the gross method. Hint, it will help you identify each receivable and payable, for example, recording the purchase on July 1 in accounts payable. Okay. You'll see that in a minute. That's kind of a stupid thing they said there, but I'll let it go. All right, remember this is business transactions for merchandising. This is what we talked about in our slides earlier tonight. All right, July 1. We purchased merchandise from Bode & Company for $6,000 under credit terms 1/5, N/30. FOB means freight on board. Don't worry about that. Don't worry about FOB. The invoice is dated July 1st. So let's record the journal entry for that transaction. Here's my spreadsheet. The date is July 1. The first account is merchandise inventory. That's an account. It's an asset account. merchandise inventory, and we're going to debit $6,000. All right, that's how much of the inventory we purchased. We're going to credit accounts payable. We owe the money, credit $6,000. All right, that's the first transaction. We're purchasing inventory that eventually, knock on wood, we're going to sell, and we credit accounts payable. Cool. All right. July 2nd, we sold merchandise to Creek Company for $900 under the terms 2/10 and over 60. The invoice is dated July 2nd. The merchandise had a cost of $500. Now remember, sports fans, when we sell merchandise, there's two entries. The recording of the revenue, called sales, and the recording of the expense, called cost of goods sold, to record what it cost us to purchase the inventory that we sold. So here's what that looks like. July 2nd is the date. All right. We're going to, remember, we sold it on account, accounts receivable, $900. And we're going to credit sales, $900. We sold $900 of merchandise, and we sold it on credit. At the same time, debit cost of goods sold, the expense account, for $500. And we're going to credit merchandise inventory, $500, because we've now sold it. What's our this is why it's called perpetual inventory. Right after this transaction, we know exactly what the balance in our inventory account is, $5,500. We have $5,500 of inventory left. We started out with $6,000. We sold $500. We now know we have $5,500 of merchandise left to sell. How much did we sell it for? We sold that $500 for $900. What's our gross profit? Here's a good examination question. What's our gross profit on this sale? Mr. Hassey, it's the difference between sales and your cost of goods sold. Your gross profit is $400. Some companies call that your markup profit. You mark up the selling price by $400, the $900, it cost you $500, you're selling it for $900. It's called markup. Also, for accounting purposes, it's called gross profit. So that's that July 2nd sale. Selling entry and an expense entry for the cost of the merchandise. You always should think that. You sell it, you have to record the lowering of the inventory and the receipt of the expense, the cost of goods sold. All right. Anybody gets confused by this, give me a shout out and I'll explain it. And also, just remind everybody, I am recording this session. You can review it later on. July 3rd, we paid $125 for freight charges on the purchase of July 1. So remember, on July 1, we bought $6,000 of merchandise. Now, in order to get that shipped to us, we got a freight bill for $125. Or freight charges, $125. It makes sense. Many times they ship it to you, you're gonna have to pay the freight. All right? You're gonna have to pay the freight. Here's that entry, July 3rd. Debit merchandise inventory, $125. Credit cash, $125. Even though freight costs are not an actual cost of the merchandise, we have to add that cost of it being shipped to us as an additional cost of the product. So now we're going to add another $125 to the value of the inventory for the amount of money it took us for them to ship it to us. Now, some companies have arrangements with some companies that the company will pay the vendor will pay, or the supplier will pay the shipping costs. But in most cases, the freight is going to have to be paid for by the buyer. And here is an example of that. And you add that freight cost as an additional cost or additional value of inventory, and you pay the bill. All right, that's July 3rd. July 8th, we sold merchandise that had a cost of $1,300 for $1,700 cash. Right? We sold merchandise for $1,300, had a cost of $13 for $1,700 cash. All right, July 8th. Debit cash, $1,700. That's how much we sold it for. Credit sales, $1,700. Now we have to record the cost of goods. Cost of goods. $1,300. Credit merchandise inventory, $1,300. That's the July 8th transaction. Again, what's our gross profit? $400 again. We sold it for $1,700. It cost us $1,300. Our gross profit on that sale is $400. Now the $400 has got to cover the other expenses of the organization. But that's what that means. Okay. Not that bad when you look at this. Yeah, but Mr. Hassey, you make this look so easy. When I see this again, I won't know what the hell's going on. That's all right. This is practice. This is your template. July 9th. We purchased merchandise from Light Company for $2,200 under the credit terms 2/15 and over 60. The invoice is dated July 9th. So now we're purchasing another $2,200 on account of merchandise, July 9th. Debit merchandise inventory, $2,200. Credit accounts payable. We owe the money with the credit terms. $2,200 credit. Oops. That's the entry for July 9th. Again, another purchase of inventory. So now we've purchased inventory once for $6,000. We sold off $500 of the inventory. We added in another $125 to the value of the inventory for freight. And now we've sold $1,300 of that inventory. And now we're purchasing another $2,200. Let's look at July 11th. Ooh, here we go. We looked at this earlier in our lecture. We returned $200 of merchandise purchased on July 9th. Here's the July 9th. We just did this, the last transaction. We returned $200 of that merchandise and debited its accounts payable for the amount. And also we received the balance from the Creek Company for the invoice dated, oh, that's July 12th, excuse me, that's July 12th. July 11th, we returned $200 of merchandise and lowered the amount of what we owe them. July 11th. There it is here. Debit accounts payable. We're lowering what we owe because we returned some. And we're crediting merchandise inventory by $200 because we returned $200 of it for being defective or whatever. We didn't like it. It didn't fit, whatever. And we're lowering our inventory balance by the $200. July 11th. Let me save this before I lose it. Okay, save. July 12th. Oh, they give us a little cheat number here. Received the balance from Creek Company for the invoice dated July 2nd. Oh, July 2nd. Creek Company purchased $900 of merchandise for us. Now it's July 12th. They paid us within the 10-day discount period. So they're going to get a 2% discount on that $900. And they paid that on July 12th, net the discount. So now they're going to pay us 2% less of $900. What's 2% of $900? 18 bucks. Here's what that transactions looks like on July 12th. First of all, they're going to give us, they owe us $900. They're going to give them a 2% discount. So that's 18 bucks. So they're going to pay us cash. 900 minus 18, $882. We're going to give them or give us a sales discount, which is $18 debit. And we're going to credit accounts receivable for the entire amount of the original invoice, wiping that out, $900. So here we're only going to get 18 bucks in cash. I mean, $882 in cash. $18 is going to reduce the sales. So if you would go to our sales account on the income statement, it would say sales, $900, and then less discount, $18. So our net discount, net sales, our net sales will be $882. That's how it would look on the income statement. Sales, credit balance, less discount, debit balance, net sales, $882. That's how we would show that on the income statement. July 12th, sales discount. July 16th. July 16th. We paid the balance due the Bowden Company within the discount period. Remember the Bowden Company? Way back when on July, excuse me, July 1st, we purchased $6,000 with a discount 1/15. So if we pay within 15 days, we get a 1% discount on $6,000. What's 1% of $6,000? Sounds like that would be 60 bucks. So we're going to get a discount because today is July 16th and we're going to within the 15-day discount period. So here's the entry. July 16th. Accounts payable. Remember we purchased $6,000 from them. Accounts payable, wipe out that $6,000 debit. We're going to credit merchandise inventory for the discount amount. 60 bucks credit. And we're going to write a check for cash to pay off the bill, less the discount, $5,940. And there's the July 16th transaction. Notice we take the discount and we lower the balance of inventory immediately. This is why it's called perpetual inventory. If I ever ask you on an examination, hint, hint, please give me an example of perpetual inventory valuation. Well, here it is, Mr. Hassey. We purchased $6,000 of inventory, but we paid it within the discount period. We lowered the inventory by the $60 discount we give. We now have readjusted the inventory balance due to that discount. That's an example of perpetual inventory. July 19th. We sold merchandise that cost $800 to Art Company for $1,200 on account under credit, 2/15, net over 60. Good Lord, these guys are easy. 60 days to pay a bill? Crazy. Invoice was dated July 19th. Would it be nice to go to Target or go to Walmart and say, oh, can I pay you in 60 days? Oh, wouldn't that be nice? This art company must be a very good customer to get 60 days net. But that's the July 19th transaction. Let's take a look at that. All right, we sell it on accounts receivable. Debit, $1,200. We record the credit to sales. We did sell it. We gave them an invoice, $1,200. And now we record the cost of goods sold, what it cost us. Cost of goods sold, it said it was $800. I'm looking at it and seeing a theme here, and I'll talk about this theme in a minute. And we credit merchandise inventory, lowering the inventory by that $800. Here again is another gross profit of $400. This company sells everything with a gross margin, a gross profit of $400. All three sales transactions have been with a profit of gross profit of $400. The July 19th transaction. July 21. Gave a price reduction, an allowance of $100 to Art Company. Remember, they just purchased $1,200 from us. Gave a price reduction allowance of $100 to Art Company for merchandise sold on July 19th and credited Art's accounts receivable for that amount. Okay? We gave them an allowance. In other words, they said, well, $100 of this stuff that we just bought from you is lousy. We're going to throw it away at our end. We're going to get rid of it. Let's return that. Here's the entry. July 21. We're going to debit sales, returns, and allowances. Another account. Sales, returns, and allowances debited the $100. That's a revenue account with a debit balance, and we're going to credit accounts receivable $100, lowering the amount of Art Company owes us by $100. So they bought $1,200 from us on account. They told us that $100 of that was crap. Maybe it was rap music. And then we give them an allowance of $100, lowering the amount they owe us to $1,100. And this goes into sales, returns, and allowances. July 21 transaction. July 24th, paid Light Company the balance due net discount. The Light Company was way back here on July 9th. We purchased $2,200. Today is July 21. They got a 15-day discount period. Looks like they came within that discount period. So they get a 2% discount of now $2,000. Remember, we returned some money on that. We returned $200 of that. So we got to now have a discount period. Excuse me. We returned $100. Let's start again, Professor Hasse. We purchased the goods here on the 24th on the Light Company for $2,200. We got a return of $200. So now they owe us $2,000. Take 2% of that. That's $40. Here's our entry for July 24th. Even I get confused sometimes about this. All right. They wipe out the accounts payable. They owed us $2,000. So accounts payable is debited $2,000. We're going to lower merchandise inventory by that discount of 2% of $2,000, $40 credit. And we're going to credit cash for what we will pay them, less the discount, $1,960. Remember, we purchased it for $2,200 here. We gave them a $200 reduction for returned merchandise. They now owe us $2,200 or $2,000, 2% discount. That's to July 24th transaction. July 30th. Receive the balance from the art company for the invoice dated July 19th, net the discount. All right. The art company, originally we sold them $1,200 of merchandise, but then we gave them an allowance of $100. So that bill now is $1,100. We take 2%, they're paying us within the discount period of $1,100. That's $22. Here's the transaction for July 30th. They are now paying us cash, debit, $1,078. The $1,100 balance less the discount. The discount is a sales discount of $22, 2% of $1,100. And we wipe out the accounts receivable for the originally amount that they had in balance. Accounts receivable, credit $1,100. Now, again, in the real world, all these transactions are done by the beep. But in our class, we have to understand what the beep is doing, and so we're doing those transactions here. 2 more transactions, and we're done with problem 5-1A, I believe. Let's double check. Yes, 5-1A. July 31st. The last transaction. Sold merchandise that cost $4,800 to Creek Company for $7,000 under credit terms 2/10, net over 60. The invoice is dated July 31. We sold them $7,000. It cost us $4,800. July 31 and the last transaction. Hooray. Debit accounts receivable. We're billing them. Debit $7,000. Credit sales $7,000. And now recording the cost of goods sold, debit $4,800, and credit merchandise inventory $4,800. Again, what's our gross profit here? The difference between $7,000 and $4,800, $2,200 is our gross profit. So, ladies and gentlemen, that is problem 5-1A. All of these are examples of the purchase of merchandise, the selling of merchandise, the returning of merchandise, the getting sales discounts of merchandise, allowance of merchandise and returns. These are all examples of retail accounting transactions that you need to be familiar with for next week's accounting problem in exam number 2 for chapter 5. So these will be posted to Blackboard, and you are to practice these or take a look at them, make sure you understand the flow of those transactions. What I would like you to do for next week is do problem 5-3 as practice for chapter 5. 5-3 is on page 205. Let's take a look at that. I want you to do this for practice. Here's problem 5-3 on page 205. I give you the adjusted trial balance for a merchandising company. All right, we've already done the entries. We've already done the adjustments. Here's the adjusted trial balance with all the merchandise, all the accounts of the company. It asks you to, and it gives you the beginning inventory of the company, and it gives you the ending inventory of the company. And then it asks you to do the following transactions. Compute the company's net sales, compute the company's total cost of merchandise purchased during the year, and prepare a multi-step income statement that separates the categories net sales, cost of goods sold, selling expenses, and general administrative expenses to determine the net income. Prepare a multi-step income statement. You can read about that in your textbook. It gives you an example. Do not do part 4 of this problem. Not do part 4. Just do the 3 parts of this problem for next week in class. One of the first things we'll do is we'll review this problem. So in other words, in problem 5.1, which we just did, we did journal entries. In problem 5-3, the journal entries are already done. You're going to put together financial information to tell me what happened. 5.3a for next week, and we will review that in class. Again, this is not for a grade. This is to have you practice. Once you do all the journal entries, what do the financial statements look like? And that's what I'm asking you to do in the first 3 parts, 1, 2, and 3, and 5.3a. You don't have to do them. The solutions will be posted, but if you can do problem 5.1a and understand that, and you can do problem 5.3a and understand that, you're in a good position for the examination. Okay, that's that. Let's move on. Oops, not that. Barbara, can you see inventories and cost of sales? You cannot see it. Thank you. Now you can see it. Thank you. All right. For the next half hour, 20 minutes or so, then we'll finish, but I want to go over chapter 6. Again, we'll be doing problem 6-1A in chapter 6 next week in class. If you want to go ahead and try to do that, problem 6-1A in chapter 6, 6-1A is on page 248 of your textbook. If you want to go ahead and try to do that for class next week, please do so. But we're going to go over that problem. That's exactly what you're going to need to know from chapter 6, problem 6-1A. Now, here is what chapter 6 is all about. Determining the cost of inventory. Let me get to my slide here. Excuse me. Remember in the problems we just did, the inventory cost is equal to the cost that you pay for inventory minus discounts plus shipping. And you're just going to see shipping in this class, storage, insurance, import duties. Now we're not going to worry about that. But inventory, what it cost us for inventory is what we paid for it minus any discounts that we get for it plus any other costs like freight. And we saw examples of that in 5-1A. Now, I'm now going to show you something. Bear with me. Get this organized here. Okay, on your screen, you should see, oops, wrong class. That's cool, Professor. All right, here we go. There we go. There we go. Here is our YouTube site for this class, Accounting 203 and 500A. This is our YouTube site. Notice here's the introduction video I did yesterday for you. Here's our class recording of last week, April 6th, our class recording. And tonight I will put our class recording up on this YouTube also. But there's two videos I would like you to review this week if you can at home. One is the Financial Accounting Chapter 5. It explains what I just did in our lecture on Chapter 5, that video. But right here, Methods of Inventory Valuation. This is Chapter 6. I'm now going to take a moment. This is only a 3-minute video. I'm now going to show this video to you as an introduction to Chapter 6. Here we go.
We hear it over and over from investors. I wish I had bought Amazon or Netflix when they were first recommended.
Hello, I am Shiba from FinanceTrain.com. In this video, I will discuss the various methods for inventory valuation and how they are used in the accounting practice. If the cost of purchasing inventory and the cost of manufacturing were constant over time, there would be no need of selecting a valuation method. Any method would have resulted in the same cost. However, that's not the case in the real world, and the cost of procuring material and manufacturing do change over time. By choosing the correct inventory accounting method, one can ensure that appropriate costs are allocated to sales and to the remaining inventory. For example, if more cost is allocated to the sales than to inventory, it will cause less profits to be shown than it actually is. Let's now take a look at the available accounting methods. The three inventory accounting methods are first in, first out, weighted average cost, and last in, first out. Let's take a closer look at each of these methods. The first in, first out method assumes that the goods produced or purchased first are also sold first. In the diagram, the goods represented by the light blue box, orange and dark blue boxes enter and leave in the same order. The light blue box comes in first, is processed, and is first to leave the facility. That means the goods purchased or produced most recently will remain in the inventory. The cost of goods sold will reflect the cost of goods in the beginning inventory plus the cost of goods purchased earliest in the accounting period. The cost of ending inventory will reflect the cost of recently purchased or produced goods. If the prices of goods have increased over time, then the ending inventory will reflect that higher price. The weighted average cost method doesn't consider the period when the goods were produced or sold. Instead, it assigns a weighted average cost to all the goods sold, including the ones that are sold and the ones that are available in the inventory. The weighted average cost per unit of goods is arrived by taking the total cost of goods available and dividing it by the total number of units of goods available for sale. The last in, first out method assumes that most recently purchased or produced goods are sold first and the older inventory is sold after the new inventory is sold. Here, the light blue box that enters the facility first is last to leave post-process. Therefore, the cost of sales will reflect the cost of recently purchased or produced items. The value of ending inventory will reflect the cost of older goods. This method is allowed only in US GAAP. If the prices are rising, then the higher cost will reflect in the cost of sales. Alternatively, if the prices are declining, the lower prices will be assigned to sales. In the next video, we will take a case study and calculate the cost of sales, gross profits, and balance inventory under each of these methods. Thank you.
Okay, again, these two videos, I know that video is a little bit difficult to hear through the WebEx system here, so you might want to look at it again. But those are the three inventory valuations you need to be studying from Chapter 6. FIFO, first in, first out, LIFO, last in, first out, and weighted average cost of inventory. Now Now again, why the instructor and why the textbook are saying, Mr. Hassey, in chapter 5, you gave us the value of the inventory in your numbers. That's correct. But guess what? That is not the real world. The real world is you receive product during the course of an accounting period, and sometimes you pay different amounts for that product. Right? Example, let's say I sell soccer balls and I have an inventory. I purchase some soccer balls from a vendor and I pay $100 a dozen. But then I place another order 2 weeks later and I buy a dozen, but now it costs $110 a dozen. And I throw all those soccer balls into my inventory. Well, what should I value the cost of those products? $100 or $110, $105? That's what these methods of inventory valuation are to do, to help you value the inventory that you have in stock. And the sole factor is how it comes in and out of your inventory. This is what chapter 6 is describing, and problem 6.1a is calculating these three methods and explain and understand how that affects your accounting entries. We'll look at that problem 6.1a in class next week, but I want you to read and understand these three methods in your textbook. And here are those methods now. Remember, we're trying to determine the value of inventory through the process. Barbara, can you see this PowerPoint slide? Thank you, lady. Thank you. So how we have to do is we have to determine what it cost us under this system. When we receive the goods and when they went out in sales will determine how we value them. That's under the perpetual system. So we're going to do this using an inventory valuation like FIFO, LIFO, and weighted cost. I can't tell you every retail company in the world has a method of inventory valuation, either FIFO, LIFO, or weighted average. And they change back and forth with them as their products change in price from year to year. This is a very important concept of retail manufacturing. Retail costs is how you value the inventory when it comes in at different prices. And this is what chapter 6 is about, how you determine that value. Let me just go through this quickly, or not quickly, but go through this process, and then you can read about it for next week. Remember, aren't you glad I decided to get rid of chapters 8 and 9 until after our midterm? We're going to spend more time on 5 next week, 6 next week, and then do a review. So please, this is to help you learn and slow it down a little bit so you can grasp this. Notice here's an example of a company that makes mountain bikes. And in the month of August, they had a beginning inventory at the start of the month of 10 units in stock at a cost. It cost them $91 to purchase those 10 units. $910 was the cost. Then on August 3rd, they purchased 15 additional bikes, but now the cost went up to $106. So their inventory value went up to $1,590 of that purchase. Then on August 14th, they sold 20 units at $130. Okay, they sold them. So we had 10 units at the beginning. We have 25 units purchased, or 15 units purchased. Now we have 25. We sold 20. Now we have 5 in stock. Then we restock on August 17th. We buy the same mountain bikes, 20 units, and the price goes up again, $115. We do another purchase on August 28th. The price goes up again. Jesus, you have a bad purchasing agent, for $119. And then we sell off 23 units on August 30th for $100. We up the selling price. Good thing, because the cost goes up. What are we left at the end of the period? 12 units in inventory. We sold 43 units. We had available 55 units. How much did we have available? 55 units. Beginning, purchase, sold, purchase, 55 units. We sold 20 and 23, 43. The difference, 12 units. Now we're going to determine with these three inventory valuation, what is the value of those 12 units and what is the value of those 43 units? Cost of goods sold, inventory. This is what this process is all about. So again, the textbook does a somewhat good job of explaining this, and you can read about it. But here's an example of first in, first out with this example. Remember, goods purchased first are the first ones sold. Goods purchased first are the first ones out. So the 12 units is made up of the most recent purchases, all right? The most recent purchases. That means those 12 units are made up of 2 units at the $115 price and 10 units of the $119 price, $1,420. What it cost us in goods sold is the first unit sold out at those prices, the beginning inventory, 10 units of the August 3rd purchased, and we're left with 5 units of the August 3rd purchase. Those units are all sold, and 18 units at the August 17th purchase. The cost of goods sold will be $4,570. These are the calculations you use to determine the inventory value. I want you to look at these three methods in the textbook: FIFO, LIFO, and weighted average. As a way of for study for Chapter 6 next week, your problem to review is 6.1a that I would like you to look at. And we will review that problem just like we reviewed problem 5.1a tonight in class. I will post the solutions to Blackboard to be your guide. And that's what I'd like you to prepare for next week. I'd like you to look at problem 5.3a and 6.1a for next week's class. Now, for some of you who came on board a little bit later, remember I explained earlier, let me bring that up. Oops, wrong one. There we go. This is our original syllabus in class. And remember, it said that our midterm is next week on chapters 1 through 9. Our midterm next week will be put on Blackboard after class next Monday, and you have a week to do it. We'll be on chapters 1 through 6. Again, remember, your project paper topics are due to Blackboard, the discussion forum, next Sunday, April 19th. And the quiz 2 answers will be posted, solutions, once I receive all our students' work. And when I do have all the students' work, I will post a video and let you know email-wise, a video explaining the grading and the answers to quiz number 2 this week. When I do post that video, I'm also going to give you a review sheet of problems that we'll also review next week to summarize chapters 1 through 6 as a template for the midterm next week. We will not worry about chapters 8 and 9 until after the midterm, April 27th. So do not concern yourself with this. So your work this week is all non-graded. Just review problems 5.3a, 6.1a. Post on by Sunday your paper topic company and an explanation of why you picked that company. If any of you need help with that, remember we have office hours Thursday nights, 7 to 9 p.m. on the WebEx. Thursday nights, 7 to 9 p.m. You can WebEx into me and ask me questions about the material. All right. Now, as we come to the end of our class this evening, Remember that we have now finished the accounting cycle, chapters 1 through 4, and we're now talking about retail accounting as described in problem 5.1a and inventory valuation accounting, chapter 6, of which we'll talk in length next week. Does anybody have any questions or concerns this evening? Please open your mics up and ask any questions you may have. Thank you, Vince. Barbara, Tori, Marianne, Barbara.
This is Tori. I'm good.
Okay. All right, guys. I'm going to shut this down. Remember, I've recorded this. Try to do those problems if you can, if you have time. I know a lot of you guys are stressed out with other work, other classes, family issues, and the whole thing. Try to do those problems. If you can't, don't worry about it. We're going to review them in class next week, 5.3a and 6.1a. I'm going to post the solutions to Blackboard later on tomorrow. I'll post your quiz grades hopefully by Wednesday or Thursday and give you some review material for the midterm. All right, guys, thanks a lot. I hope everybody's okay. Appreciate your concentration this evening. Again, you might want to review this video if you have time down the road this week. Might be a helpful thing to do. And thank you all. I wish you a good evening and thanks for coming. See you all next Monday, but I'll see you on the internet during the course of the week. Thanks, everybody.
Thank you, sir.
Thank you.
Thank you.
As I walk this land, I have visions of many, but happiness just can't just feel all the sadness and confusion.